I'd like to welcome you back to our continuing In the Trenches series. Today you've got your baseline set of presenters. Craig Nazzaro and I will be talking with you today. Now, with under a week left before the final day of the general election, we're talking about something that's on a lot of folks' mind right now, particularly in the financial services space, which is what will different outcomes of the election, different administrations have on the financial services industry? You know, what can we expect if the Trump administration and President Trump is reelected as president? And then conversely, what should we be looking at, and what should we expect if Vice President Biden is elected president, and particularly if Vice President Biden is elected president and Democrats successfully flip the Senate to control all three branches, or all of the two branches of government, including both the Senate and the House. And so today we're going to be talking about some of these policy positions that have been taken, a little bit about what we should expect looking forward into 2021 and 2022, and some of these different outcomes that are potential. A few notes today, given that this is a very hot button political issue. Really we're going to try to take an extremely objective look at different articulated policies and initiatives. We're going to look at the economic teams that both of the candidates have assembled, or in the case of President Trump, some of the current policies or fiscal year 2021 budgets that have been put forward by different cabinet agencies. We're then going to shift and talk a little bit about regulatory focus, particularly at the CFPB, because I think that's one of the most interesting scenarios that potentially could come out of this election. Really the thing is today, we're going to try to avoid guessing or speculating. There's all sorts of stereotypes about how different parties or how the different administrations would address financial services. And not to say that some of those may not occur, and that some of the kind of deeper policy goals of the two parties may influence or guide their policymaking and decisioning. But really here we're going to focus on what the actual candidates' positions are and what's likely to occur in the event of either the Trump administration remaining in control of the White House, or there being a change in the White House and Vice President Biden assuming the presidency. As we say throughout today, we'll be trying to focus on those policies. We've got links at the end of this presentation if you're interested to all of those source materials that we consulted, so that you can look at them as well and kind of see in more detail what the positions were respectively. Where we're talking about things back and forth, we'll generally talk about Vice President Biden's policies first, and then the administration's policies, simply because B comes before T, so please don't take anything from our ordering of the various topics in the presentation. Before we get in, though, let's really talk about kind of where we stand today, because I think this is guiding a lot of our discussion, is going to be guiding a lot of the policy responses we see coming about post-November, even into potentially a lame duck presidency, or conversely, the kind of remaining time, if there is a change in the presidency, when President Trump is in office and Republicans control the Senate, what that looks like. Or similarly, if President Trump is reelected and Republicans maintain control of the Senate, what are the economic challenges that are going to be during that interim period before January? And so, these are the latest numbers from the Federal Reserve, both the New York Fed as well as the St. Louis Fed. If you're looking and kind of saying, okay, what's the current state of play of the U.S. economy? Obviously, we've seen unemployment spike, but it's kind of coming back down into the high single digits right now. Great news for the economy. But as you can see on that one on the left, we went back to 2000. And if you've listened to some of these webcasts in the past, you'll see traditionally that default rates and delinquency rates tend to mirror what you see in unemployment. Interestingly, we're not seeing a huge spike yet in delinquencies and defaults, and we've got various theories as to why that is. Some have theorized that it's a trailing indicator, and because of the aggressive stimulus packages that have been issued, those spikes are going to occur later. Nonetheless, we are seeing some slight spikes when you actually break down. The Federal Reserve Bank of New York released this through Q2 of 2020. This is based on Equifax delinquency data, so this tends to run in advance of the St. Louis Fed's governmental data. And if you can see, we're still seeing a pretty significant spike in credit card delinquencies, Other, which includes non-mortgage, non-auto, so those tend to be kind of general consumer loan products, and auto loan continues to creep back up. When you compare that to the heights of the late 2000s recession, credit cards still well under what we saw at that point in time. Student loan delinquency still particularly high, but dropping likely due to some of the federal programs that have granted relief for students with federal programs, and then private student lenders tending to match a lot of those policies for those students. Mortgages continue to stay low. I mean, as we've seen, housing market continues to be extremely strong. Housing market, we still see home sales being very robust. People are not losing money inside of their homes. So defaults and foreclosures have stayed fairly constant there on consumer home lending. So really good news there, given that was one of the drivers at the end of the 2000s recession. That being said, that's the world in which either the administration will find itself post November, maybe mid-November by the time we actually get the results of the election this year, or potentially a new administration finds itself within as they take over the reins of power. So we'll start and kind of talk generally. If we think about Vice President Biden's economic agenda, this is kind of what he and his campaign have articulated as their big picture principles, things that directly impact on the financial services industry, and we'll go into a lot of these in detail. But I think one of the key themes for those of you who are in a compliance role or work within compliance inside of financial institutions or financial services companies is the Biden campaign, both originally and particularly after the campaign involving Senator Warren and Senator Sanders through these reconciliation groups, has really placed a new emphasis on Dodd-Frank. And all of us obviously know one of the key provisions of Dodd-Frank is building the strength of the Consumer Financial Protection Bureau, and likely a Biden presidency would see, to different levels, a re-strengthening or reinvigoration of the CFPB. One of the things we'll talk about a little bit later on in the presentation is you can kind of debate where the CFPB is at present, but I think it's fair to say during the period when Interim Director Mulvaney was taking over, he's on record as saying he did not like the policies of the CFPB and was really looking to limit the role of the CFPB and some of the aggressive enforcement actions that were being taken by the Bureau at the time. And so, I think by all accounts, there was a weakening of the power of the CFPB under Director Mulvaney. Director Kreninger has attempted to kind of find, I believe in her view, a medium between the two extremes. But certainly the Biden campaign has proposed an aggressive re-strengthening of Dodd-Frank. Interestingly, the Biden campaign has also focused on separating commercial and retail banking, really focusing on re-strengthening some of the Glass-Steagall protections that would separate those two. Again, coming out of some of the results of the early 2000s, mid-2000s recession, some of the deregulation efforts, there's an articulated position to try to reinforce some of the restrictions in Glass-Steagall. Both campaigns, but particularly the Biden 2020 economic agenda, has focused on small business funding, particularly focusing on minority business enterprises and women-owned business enterprises. There is a obvious credit gap if you look at economic data right now in terms of the availability of credit to WBEs and MBEs. Some of that, interestingly, has been closed through the PPP program. We were doing some updates to our PPP tracking data last week, and it is tending to mirror in terms of the number of folks obtaining PPP loans. What you see in terms of the percentage of small and medium-sized businesses that are, in fact, minority business enterprises or woman-owned business enterprises. And so as a result of that, PPP has done a great deal, I think, to try and make, at least attempting to make credit available for all. But still, when you look at it in the aggregate, there are discrepancies in terms of raw data between MBEs and WBEs and the access to credit. And so certainly one of the focuses of the Biden campaign has been to really encourage that type of lending. As we get towards some of the more what I would call controversial topics that we'll be talking about today. One of the campaign articulate positions, and this was part of the joint position that was adopted from the Sanders campaign, is the creation of a postal banking system that you see in some European countries. And this would be a specific financial program offered by the U.S. Postal Service. It would provide not only access to payment and kind of quasi-depository systems, but also potentially lending, and we'll talk about some of the theories around that. But nonetheless, a initiative to create a free government-sponsored banking system, specifically focusing on low and middle-income families.
Hey, Brad.
Also, yeah, jump in, Craig.
Just because you brought up PPP earlier, before we get too far beyond that, I don't think we have that in the slides to come, but it may be worth mentioning that the PPP program, while we're starting to process forgiveness applications and we're starting to see the sale of some of the portfolios between banks and into the secondaries, it would be good to note that whichever administration takes over in November or going forward is going to change the tone drastically about what the audit and look back is going to look like within that PPP portfolio. I know we've had a couple clients that are just starting to go through exams now in the last month or two, and the EICs are opting not to look at the fair lending the PPP portfolios just yet, but have acknowledged that, hey, we're going to be looking at those in the near future, and given direction to, you're going to want to start to test those portfolios and look at your controls that are on those. But the way those portfolios are treated is going to be dependent on the election as well.
Yeah, I think that's a great point, Craig, because I think regardless of what happens in the election, to your point, when we talk about the back end auditing of PPP, there's already significant allegations of fraud that different groups have asked to be investigated. But similarly, you have the fair lending aspects of PPP that have also been implicated. And as any of you who participate in PPP, whether as borrower or as a lender, you saw that the PPP forgiveness application actually implements what has been a long-term plan of the CFPB, which is to start collecting demographic data on small and medium-sized businesses obtaining this PPP loan. So it's very easy then for SBA to assemble a database to look at your institution's lending to different protected classes of individuals, in the same way that you have, in essence, a HMDLR that looks at your consumer mortgage portfolio. There is now this data set that's been created for PPP that will be available for those regulators to look at fair access to credit concerns. Interestingly, the Biden campaign has also proposed a public credit reporting agency as an alternative to the traditional CRAs. This is a proposal that originally came out of the Sanders campaign, but it would include non-traditional data sets. And obviously what I'd call the big three credit bureaus, Experian, TransUnion, Equifax, have already started to push a more inclusive consumer report that would include non-traditional sources of data, such as utility payments, rent payment history, mobile phone payments, what have you. Although the adoption by the lenders has been slower for those non-traditional data sets. This would create a governmentally owned and sponsored public credit reporting agency. And most importantly, all government-based lending would then use these data sets as opposed to the big three credit bureaus as the basis for making lending decisions to individuals. So for instance, SBA loans, certain federal mortgage programs, federal student loans would all back end onto this public credit reporting agency. One of the kind of key points that has been raised by Vice President Biden during the debates, as well as on his policy position statements, is to increase criminal penalties for executives or management of financial services companies. Here we have the direct quote from the policy statement that was issued by the campaign. It's not clear exactly how this would be implemented, but if you've watched any of the debates or watched some of the campaign speeches provided by the vice president, you will have heard him reference specifically folks who during the economic recession he asserts were let go without penalty even though they engaged in reckless behavior in the financial services space. And then interestingly, and I think perhaps what could be a highly technical point, but that could significantly change how we think about the regulation of the financial services space, is to re-articulate the Federal Reserve mandates, meaning there would now be a specific mandate written into the chartering documents for the Federal Reserve that would mandate that the Federal Reserve take steps to build racial equity, including mandatory reporting and monitoring of racial equality, including employment and wage gaps, and articulated positions and steps that the Fed would follow to counter discrepancies or counter inequities amongst the races and access to financial services. And so, obviously there is push already at the agencies for this, but this would actually redefine the Federal Reserve mandate in what I believe would be an extremely meaningful way that could significantly change how the Fed approaches some of the deployment of financial resources in the U.S. Shifting gears a little bit to the Trump campaign, the Trump campaign has not articulated an official position as to economic agenda in 2021 going forward. So for this, what we've largely done is look at statements by the president during campaign stops, as well as during debates, as well as you'll see we're focusing a lot on the fiscal year 2021 Treasury budget, as well as the overall administration budget. I think what you can expect if the president retains the White House is really more of the status quo. I mean, one of the key points of the 2016 election for the president that I think has been carried forward as we talk about the debates is this concept of the need to deregulate governmental agencies, though it's not truly been enforced in this way. But the campaign statement is the 2-for-1, which is remove 2 regulatory rules for each one that's been put in place. And certainly the administration has focused on trying to walk back regulations or taking a more conservative approach to regulations. And we'll talk about a little bit about that as we talk about particularly some of the CFPB rulemaking that occurred under the Trump administration and how that was guided by this principle. But, we certainly would expect that type of approach to governing continuing. Also easing of the Volcker rule. In particular, the administration has said they would focus on allowing institutions with less than $10 billion in assets to resume proprietary trading, start working in venture capital again, and working with hedge and private equity funds so that you could start to generate additional non-interest income because of that easing of the Volcker rule. And then finally, the administration has proposed a broader definition of what counts for CRA credit, and it could be things as broad as the position they've taken that stadiums and hospitals, other community development initiatives would count as CRA. It would not be the somewhat limited definition of community reinvestment that's presently in the Act that focuses on traditionally underserved communities, farm credits, et cetera. Instead, this would actually broaden it out so it would also include community-based investment and community-based lending that may not be as targeted as what's in the existing CRA regulations. We're not going to go through this in a ton of detail, but if you're interested, here are some of the known folks who are driving the Biden campaign's economic policy. It's interesting. The campaign requires economic advisors to sign an NDA, and American Banker, Wall Street Journal, CNBC, others have tried to interview different folks, and they all say they can't even confirm they're part of this team. But when we look at who we believe are part of the key economic advisors, it's really across the board. But what I think you'll see as you look at these different bios is you really have 2 groups coalescing within the Biden economic advisor camps, which is one, you have the legacy Obama administration economic advisors, folks like Ben Harris, Jared Bernstein, others who were instrumental with the Obama administration, some of their policies coming into the Biden campaign. And then you also have what I would call kind of the folks who were working in the Bernie Sanders or Senator Warren camp who have come over and begun advising the vice president and his campaign, folks like Julie Siegel, who continues to work for Senator Warren's office as an economic advisor, as well as other advisors who are coming over from the Sanders campaign. When we look at the backgrounds here compared to the Treasury departments currently under the Trump administration, what you'll see here is much more, trying to think of the right word here, but a much more aggressive approach to economic policy as a tool of changing economic mobility, as a tool of changing racial equality, as a tool of gender equality. And so you'll see, if you look kind of at an overview of these various advisors, that you have some of the leading experts on economic policies and the impact on women, economic advisors and the impact on race, economic advisors and the impact on education and education mobility. And so as we take all of these in total and kind of blend that together, what we've seen is about half of the economic advisors, if not more, are those folks who tend to view economic policy as a tool of social change, I think is a fair way to assess that. And so based on that, we would expect, when we talk about, positions inside the administration, that these individuals would be advocating for a more aggressive approach to governance, a more aggressive approach to economic policy, less laissez-faire, and more as a tool of social or governmental change. And we see that same thing when we look at potential leadership under a Biden White House. And, here, depending on who you talk to, are some of the leading candidates for both Director of the Bureau as well as Secretary of Treasury. And you see, again, that same, I guess what I would call spectrum, where you have about half of these folks who are holdovers from the Obama administration or long-term supporters of Democratic presidents and their economic advisors. And then you also have what I would call the more progressive wing of the Democratic Party, and these were folks who either, in one case, is in fact Elizabeth Warren, or worked with the Warren campaign, worked with the Sanders campaign. And so on the Bureau side, you've got Richard Cordray, obviously, who was the long-term director of the CFPB, who really helped incubate the CFPB under the, I guess, in partnership with and under the tutelage of Senator Warren. We would expect there, in essence, more of the same, where, Director Cordray would come back in and really take an aggressive approach to enforcement and really building it up as a powerful entity. Rohit Chopra, interesting background, current FTC commissioner, but has a background, particularly in the student lending space, serves as special advisor to DOE, was the ombudsman for student affairs at the CFPB, was deputy director and helped Richard Cordray and the establishment of the CFPB. We expect that if he is announced as CFPB director, you'd see a lot of focus on student lending and some of the protections related to student lending. Patrice Ficklin, who was with the Office of Fair Lending and Equal Opportunity, so obviously that will likely guide her stint if she is elected director. One interesting kind of outside runner is Representative Porter, Democratic representative from California. She worked closely with Elizabeth Warren and counts Elizabeth Warren as one of her mentors. The interesting kind of note here is she was appointed when vice presidential candidate Harris was Attorney General of California. Katie Porter was kind of put into a position to oversee the California mortgage settlement process. So a very powerful role there in deploying the nationwide settlement funds in the state of California. And so given her ties to vice presidential candidate Harris, as well as her ties to Elizabeth Warren, that's kind of an interesting outside choice, and that's a fairly solid Democratic seat that would be vacated in a strongly Democratic state, so no real concern about a congressional seat flipping there. You have Adam Levitin, who was on the Consumer Advisory Board. He's also a mentee of Elizabeth Warren. He's somewhat more of the academic type who actually was an economist overseeing some of the TARP program on behalf of Congress. So interesting pick there. And then last we have Bharat Ramamurthy, who economic advisor to the Warren campaign, Warren senior counsel, And the tie there was Chuck Schumer's appointee to the Congressional Oversight Commission, who is overseeing COVID-19 relief programs. So very involved right now in some of the COVID and CARES Act response. Similarly, when we talk about Treasury, you've got some really interesting players. First, you have Miss Bernard, who is currently on the Fed's Board of Governors. She is generally viewed as kind of a moderate consensus candidate. If you read some of the articles in the Financial Times or CNBC, she is viewed something as a front runner because of her ability to calm financial services companies. So that's kind of the moderate consensus pick. Obviously, Senator Warren, given not only her influence during the election, but also her work historically on consumer advocacy. A lot of folks, particularly very progressive economic groups, are really advocating for Senator Warren to take over the Treasury. Obviously, the concern, if you're the Biden administration, you win the election, is that may spook the financial services industry. And then you've got some folks next to Roger Ferguson and Raphael Bostic, both who were previously involved with the Federal Reserve System. One FRB vice chair, Ferguson is now the CEO of TIAA-CREF. However, interestingly, a lot of folks have said he would likely turn it down. He had been talked about as a Fed chair previously, and presumably declined that position. So there's a question about whether or not he'd actually assume that role. One of the most interesting, I think, and potential future frontrunners is Raphael Bostic, who is the president of the Atlanta Federal Reserve, who was actually on Face the Nation last week, was specifically asked about becoming Treasury Secretary and refused to answer the question, or at least, said he would not turn down such an offer. Interesting play there because not only does he have the distinguished position of president of the Federal Reserve of Atlanta, which is one of the most advanced Fed banks when it comes to payment processing and fintech, but has also published on the intersection of equality and access to financial services. So really interesting pick there. All four of those folks could also be history making if nominated to Department of Treasury. Department of Treasury is one of the cabinet positions that has never been held by an individual other than a white male. And so any of these four first individuals would change that long-standing position either to an African-American male or a female. And then last is Larry Fink, who is somewhat controversial because of his role as at BlackRock. Certain progressive groups really don't like him because they view he is not progressive enough, especially given BlackRock's investments in the defense and energy sector. However, he has also been one of the leading advocates of socially responsible investing, and a number of what I would call the more centrist side of the Democrat Party have been really pushing for Fink to take on the role of Department of Treasury. I'm going to cover these fairly quickly, but just wanted to do some back and forth to really understand the candidates' different positions on key parts of the economy. And so, for instance, we'll start off here on mortgage lending, and as Craig alluded to already, we've seen already a dramatic shift in how we think about mortgage lending, how we think about consumer defaults. Unlike the last financial crisis, where there was something to blame, banks, lenders, kind of got the rap for that. In this particular election, we're blaming a virus, a pandemic, and so both sides, I think, interestingly, have been very open to more accommodations for consumers, and we'll touch on that here a little bit as we go through these. So you don't have quite as much of a difference between the two, but for the Biden campaign, advocate for homeowner and renter bill of rights. Basically, lenders would be held to a standard where they had to appropriately price credit based on an individual's credit history. They couldn't, quote, overcharge folks. Biden would bring back the $15,000 first-time home buyer credit that came about as a result of the last recession that then aged out. Would strengthen, like we talked about earlier, private rights of actions against mortgage lenders. would really focus upon enforcement of HMDA and disparate impact discrimination. You know, that's something the Biden campaign has cued off on. But I think anyone, regardless of how this election comes out, you need to be thinking now about HMDA, how you're going to be doing your disparate impact testing, because I think regardless of the administration, it's going to become a hot issue. We've already seen the building blocks put in place both for small commercial lending as well as continued focus on residential. If this isn't one of the top of your priority list for your 2021 compliance and regulatory agenda, you know, it really needs to be, because I don't think the election is going to impact that focus whatsoever. You know, as we said, good, Greg.
Also, just from like historically looking at the cycles, if the credit markets, you know, stay a little stagnant, or the economy is not as quick to rebuild as we're thinking, traditionally you would see fair lending claims start to rise there as credit markets tighten, no matter who wins the next administration. To Brad's point, it's going to be a focus. Like you're also seeing a perfect storm of, you know, the redefinition of HMDA data collection. We're going to talk a little bit about small business and small business loans to minorities and women data collection. All that is laying the groundwork for an environment that's going to bring drastic changes to the fair lending actions that we're starting to see. When you couple that with an economy that is not quick to recover or that is stagnant, it's a good recipe to start to see those claims start to rise quickly.
You know, and then one of the more interesting proposals that the Biden administration is putting forward that could impact mortgage lenders significantly is redefining appraisal standards that would not only require affirmative education of appraisers on non-overt indications of discrimination, but also set forth new standards, particularly in communities of color. And so, you know, that could have a significant impact in terms of how we value properties and what the standards are, as well as how you work with appraisers and how mortgage lending is conducted. So it could be a really interesting shift there. You know, what in terms of 2021 agenda coming out of HUD as well as the Treasury budget for 2021, you know, perhaps one of the most significant changes would be the government entities program would actually have an explicit paid-for guarantee to back mortgage-backed securities, meaning it would not be a kind of first loss, last resort. Instead, it would act more like an insurance program, and instead would serve as an instance of last resort for these mortgage-backed securities, meaning instead the government would charge a fee to the lender that would then be passed on to the investors in the securitization, as opposed to the governmental entities actually taking on the role of providing this kind of unlimited guarantee. It would just be one portion of a broader package of credit enhancements for the investors in those particular securities. So, you know, something to be aware of there as we go forward. You know, government guarantees would be priced according to risk, so and there would actually be revenue generated off of those guarantees. Could not use federal subsidies to offset local rent control laws, so in essence would start to really undo some of the changes under the Clinton and Obama administrations to allow local rent control laws to be counteracted by housing subsidies. And, you know, also interesting, transferring LMI, rural and underserved borrower funding programs into HUD and taking it out of the GSEs. In essence, trying to de-lever the GSEs and keep them from holding loans on their books, and instead acting simply as a, you know, insurance or backstop agency in the mortgage world. One of the most significant splits I think you could see would be the changes in small dollar lending. So this would be payday, title, or higher interest consumer lending. You know, obviously there was significant Democratic pushback to the removal of ability to repay rules from the CFPB small dollar lending regulations. You know, Biden went so far as at one point to refer to that as a windfall to predatory lenders. But, you know, not only would we expect some sort of effort to try to reinstate those ATR rules, whether that comes through rulemaking or through affirmative legislative action, particularly if the Senate were to flip post-election. But we also expect some changes to the debt collection rules. We've just had those come out in terms of proposed rulemaking. Already objections filed by some of the consumer advocacy groups, including the NCLC and others, in particular trying to limit the use of social media, text, and electronic communications with borrowers, and really working to affirmatively limit the collection of uncollectible debts and trying to keep folks from making a payment or recommitting to a debt, such as to restart the collection process. So we'd expect certainly some pushback there. In terms of what the Treasury budget and the statements by the current administration's Treasury director has said is continued rollback of Obama-era regulations, continued rollback of some of the rulemaking that the Bureau has engaged in over the last decade. One thing we'll talk about in a little bit more detail is if you think about how aggressive Director Mulvaney was when he was at the CFPB in terms of trying to take down some of the focus on enforcement, how he changed some of the Equal Credit Opportunity Act oversight and the structures within the Bureau. Director Craninger has recently been really publicizing her focus on enforcement, and you'll see some of these statistics a little later on that if you look at 2018, 2019, 2020, you see this market increase, and so some have been speculating that she may be in essence trying to build her resume to stay on as CFPB director, at least on a temporary basis. What could be extremely helpful for the industry is there is proposed clarification of what constitutes abusive under the UDAP standards of unfair, deceptive, and abusive acts and practices. That'd be really helpful to get a little additional clarity because that is, one of the more flexible terms right now under that UDAP standard. Certainly we would expect if President Trump wins this election and retains the White House, that there'll be continued fights between state and federal regulators. We've already seen it in some states, such as Virginia with its 36% lending cap. You now have the Treasury agencies, including the OCC just yesterday, going final on its rule relating to valid when made and trying to create a clearer path to bank model partnerships for higher interest lending. And so we likely will see that tension going back and forth. In addition, one of the more dramatic shifts has been in student lending. As you can see there, the Biden campaign has stated that it wants free tuition for families making less than $125,000, free two-year college, doubling the amount of Pell Grants, specific focus on public colleges and universities, historically black colleges and universities, and minority serving institutions, including debt cancellation for students earning up to $125,000 a year. And I think most importantly for students, or those of you in the student lending space, would be some of these proposed shifts into the income-driven repayment plans. The Biden campaign is proposing to cap that at 5% of discretionary income with a 20-year maximum, and walking back the provisions that made it more difficult to discharge student loans in bankruptcy. President Trump, on the other hand, has proposed a unified IDR program, so you'd get rid of the three programs currently in existence, and there'd be a 15-year max and a 30-year max, so shorter for undergrads, longer for graduates than what the Biden campaign is proposing, and would be a unified 12.5% of discretionary income as opposed to the 5% the Biden campaign is proposing. And any delinquent borrowers automatically enrolled in IDR so that he or she receives those benefits. There'd also be limitations on graduate loan or graduate plus loans, which right now are being used to finance graduate education for those who are attending graduate school. And there would be an end to the public service loan forgiveness program that currently exists that helps those in public service get a portion of their student loans forgiven each year. The real interesting thing here, if you're looking at from a macroeconomic standpoint, is if you tighten grad plus, you tighten parent plus, what effectively you will either do is force a larger role for the private student lenders that are out there right now, because that's typically the next level over those two programs, or potentially it could impact the cost of attendance at different universities, particularly in their graduate programs that traditionally have had significant benefits through the Graduate Plus program. Last piece before I toss it over to Craig to talk a little bit about some of these COVID plans is if we look at some of the tax policies back and forth between the two, this has gotten a lot of media coverage throughout the campaign. But some of the things to really be aware of is obviously there would be a shift in the top tax bracket going from 37 to 39 in terms of what potentially is the most meaningful for financial services companies is the corporate tax bracket would shift from 21 to 28% under a Biden administration. Cap gains would be taxed at the short-term rate if individuals are making more than $1 million, and there would be, in essence, an alternative minimum tax, but now imposed on corporate earnings, a 15% minimum on companies' book income, even if they otherwise would be able to have lower taxes. There'd be this minimum threshold based on book income. Finally, some efforts by both to try to, quote, bring it back to America, if you will. And so the Biden campaign is proposing a double tax rate, moving the tax on profits earned by foreign subsidiaries up to 21%, and a 10% surtax, or some people refer to it as surcharge, although it's technically progressive, so surtax on companies with overseas production for sales to U.S. markets, meaning if you offshore production and then ship it back to the U.S., you'd be subject to that surtax of 10% that would come on top of what you would already pay in taxes for those particular sales. The Trump administration generally would extend the tax reforms that are currently set to expire in 2025, would eliminate renewable energy tax credits, and when we're talking about infrastructure and funding, would actually help put in place Secretary DeVos, Secretary of Education's education freedom scholarships. They would create a tax credit program for people donating money or giving money to states to help develop what I would call non-public or semi-public educational programs like tutoring, dual enrollment, private school, what have you. President Trump has said he wants to expand the Opportunity Zones program as well as make permanent some of the payroll tax cuts and generally a Made in America tax credit program. Although I don't know that we've seen the details of that yet released, but I believe very similar to what the Biden campaign is proposing, is there would either be tax credits for businesses manufacturing in the U.S. or potentially a surcharge or surtax for those manufacturing outside of the U.S. Here, we'll start teaming up, Craig and I will, and really talking about some of these economic plans. But, as we say, we'll start with Biden as opposed to Trump, just because B comes before T. But if we look at what Vice President Biden has articulated, his campaign has articulated in terms of their economic plan to respond to COVID, a lot of these things you'll see in both programs, which is continued unemployment benefits, continuing the PPP, restrictions on corporations. We saw this already in the Main Street lending program that would reduce stock buybacks, some of the incentives or executive comp associated with receipt of federal funding. Vice President Biden has started to really focus on the development of PPP availability as well as guaranteed governmental testing, as well as free treatment and guaranteed sick leave. One of the things you'll see that the parties diverge most significantly on is this concept of, state subsidies and student loan forgiveness. The Biden administration is proposing $10,000 of forgiveness for every person on their federal student loans. And then obviously the Biden campaign is advocating for strong support for state and local governments that have been impacted by COVID-19. Compare that to the Trump proposed stimulus plan, and this is based on the $1.8 billion plan that was put forward to Congress, plus some of the agreed upon changes that Secretary Mnuchin and Representative Pelosi had discussed. But it would extend the direct payments, $1,200 for each adult, $1,000 for each dependent, and that's subject to an income cap. $75 billion to enhance coronavirus testing. Continuing the increase of unemployment benefits by $400 per week, which would be a partial continuation of the existing program. One of the more controversial topics has been a federal legal liability shield, meaning anyone who is impacted by COVID would not be subject to liability for reopening in the face of the COVID pandemic. But then more money for PPP, $10 billion specifically earmarked for what is described in the program as minority lending, that we assume would be focused on MBEs and potentially WBEs. $150 billion for state education programs, colleges and universities. A lot of that money is focused on reopening those colleges and universities, and there are restrictions on the use of that for e-learning. Employee retention tax credits, mortgage and rental assistance, a lot of this already exists. Plus, like the Biden campaign, a partial forgiveness of student loans, meaning a lot of students or former students have taken advantage of that deferral. And this would forgive or put $25 billion aside to forgive those deferred payments and basically reset those individuals to a baseline of zeros that had made those payments during the time. And then obviously state subsidies, one of the more controversial topics going back and forth. The initial proposal by the administration was for $150 billion, and they have agreed to up to $300 billion in the latest negotiations between Secretary Mnuchin and various leaders in the House. Craig, I guess I'll turn it over to you, and we'll talk a little bit about as we look forward to what a Biden administration would do. A lot of that is looking back to what were the Obama-Biden era initiatives that either weren't accomplished, were key, or maybe holding over and could be reactivated.
Thanks, Brad. So to Brad's point, a lot of this is going to be if Biden were to win the election, you would start to see a reverting back to what Obama's regulatory scheme looked like, what the CFPB looked like, what their priorities were. Here we have some just bullet pointing out what they were. Affirmatively furthering the fair housing rule, risk-sharing programs where the federal risk-sharing program that secured financing for affordable rental housing in partnership with housing finance agencies, interest rate caps, interest rate restrictions, and a disparate impact analysis that the Bureau has since moved away from during the Trump administration. A lot of that, again, to Brad's point earlier, is fair lending focused and fair banking focused. So again, we just want to drive home the point that this is going to be a focus under the Trump administration and more so under a Biden administration. Next slide, Brad. And when we're thinking about what it looks like, not only are we looking back to what the Biden era CFPB leadership looked like, but we want to see what the statements look like, what the tone from the top was. It drives not only new rule promulgation and supervision activity, but also enforcement of the rules that are currently in place. When Cordray, we have two quotes here, one pulled from Cordray, one pulled from Mulvaney. You see, if you read the Cordray quote, that he was really on the side of the consumer. He viewed the CFPB as a tool for consumers to protect consumers in the financial service markets, while Mulvaney looked at it as a regulatory agency that had oversight, but was not in a constant conflict with the financial services industries. He literally said the days of aggressively pushing the envelope are over. And you'll see that as we go through some of the numbers and some of the statistics in the slides to follow, what that tone from the top looked like in terms of enforcement actions and in terms of budgeting, and just what you saw in your daily interactions with the EIC teams and the enforcement teams. Next slide, Brad. So after Mulvaney took over, you start to see a lot of criticism because you can see in the statistics how they were removing the teeth from the CFPB and how even with the same rules and regulations out there, with the Dodd-Frank Act still mostly intact, what a scaling back of the enforcement activity looks like and scaling back of the supervision activity. The two charts we have up here is the enforcement activity decline under Trump-appointed leadership. That only goes through 2018. We expand on that in the next slide. But we also see the CFPB consumer relief under Obama and Trump-appointed leadership and how that drastically fell off. That's only through May of 2019. It has increased, as Brad has pointed out earlier. Director Craig Nazzaro has really stepped up the enforcement actions and her supervision activity. Some say that is to pad her resume to stay as director of the CFPB going forward, but it is an interesting it is interesting how that's going to play out after the election if Biden does get in. Next slide, Brad. Here are the enforcement actions throughout the history of the CFPB from 2012 to 2020. It's important to note that in 2012, the CFPB was first on the scene. They only had oversight of mortgage at first. As that oversight started to grow and started to include other consumer lines of businesses, under Cordray, you see the enforcement actions topping out at 54 in 2015. The election comes in 2016. The enforcement actions start to decline. Mulvaney takes over as interim director in late 2017. You then see in 2018, true to his statements, the enforcement actions hit a low of 11, excluding that 2012 when they only had mortgage. Then in 2019, when Craig is appointed director of the CFPB, you start seeing creep back up. You have 25 in 2019, and you have 31 in 2020. However, it's important to note that that last bullet point there that we'd like to show everybody, 22 of those 31 enforcement actions so far in 2020 were filed in the last 4 months. It's also important to note that the enforcement actions that were filed under Mulvaney and Craig were not viewed so much as the enforcement actions under Cordray were as enforcement, supervision through enforcement. They weren't looking at changing the definition of the rules, or changing the guidance that was out there in various lines of business through their enforcement activity. They weren't regulating through enforcement. Cordray and Cordray CFPB was constantly criticized for bringing enforcement actions for activity that was generally accepted as permissible within the financial service markets. And then that has disappeared under Mulvaney and of Craig. While the enforcement actions have started to increase, that criticism of regulation through enforcement hasn't arisen again. If Biden's administration, if Biden wins the election and the Biden administration appoints a Richard Cordray type leader, we might start to see that in enforcement through, regulation through enforcement activity start up again. And that's where it becomes very expensive for those in our industry, because we have no clear line. We don't know what the CFPB is going to focus on, and we don't know where the thresholds are. So I would keep that in the back of your mind as we see the results of the election start to roll in. Next slide, Brad. It's also important to look at the CFPB's funding. The director of the Bureau every year requests from the FRB to transfer funds in the amount that he or she has determined are reasonably necessary to carry out the Bureau's mission. If you look at the chart to the right, you start to see again how that increased under Cordray and then took a nosedive when Mulvaney came in and he slashed the budget, and it started to increase again back when Craig took over in late 2017 throughout 2019. It was more of a $200 million drop, but it'll be interesting to see how that plays out if there is a change in administration, because the decrease in budget really did manifest itself in enforcement. A large portion of the CFPB's budget under Cordray was spent towards the CEFL division, the Supervision, Enforcement, and Fair Lending division. When that took a $200 million hit is when we start to see those enforcement actions scale back. We start to see the supervision activity scale back a little bit. They weren't as aggressive when they were in our reviews. They weren't pushing the envelopes. They didn't have many attorneys dedicated to the secondary review of these actions. So if the budgets does start to increase and they start to increase the FTEs within CFPB, we can expect more activity in those spaces and a more robust oversight function. Next slide, Brad. This is a slide that we try to exhibit what the collection looked like. Again, under Cordray from 12 through 16, you see it increase and increase and increase. You see it take a nosedive in 2017 and spike. That one spike in 2018 is the result of one enforcement action that had a large collection attached to it. So it is kind of an outlier. And then it hits a record low in 2020 through the second quarter. Again, it is starting to increase again under Director Craig, but it's not nearly where it was under Cordray. So we can start to see we can expect if there's a change in administration to not only see an increase in enforcement activity, but the fees and penalties increase as well with the enforcement actions that we see of the supervision activity that we see.
I think they're correct too. I mean, that's one of the Biden campaign's stated goals is enhancing the collection tools that are available to the CFPB to make it more likely that civil monetary penalties and other consumer redress are collected, not just awarded, and really adding additional, quote, teeth to that process.
Agreed. And to Brad's point there, when we start to touch on fair lending activity, when Brad was going through what some of the changes would be under a Biden administration to the CFPB, he mentioned Patricia Flicklin, and he mentioned that the CFPB was restructured. That restructuring moved the Office of Fair Lending out of CEPFL. It removed it out of the Enforcement and Supervision Division. It gave her office less oversight of the penalties and fees, less oversight of who to pursue for supervision and enforcement activity. If that is restructured again, you can expect a stronger fair lending division within the CFPB. You can expect to see the civil monetary penalties increase. You can expect to see the enforcement activity increase. To that point, when we're discussing that reorganization, we saw most recently in the 2019 House Financial Services Committee meeting, Craig Nazzaro was asked why the CFPB has not issued any fair lending violations for a full 6-month period, citing the CFPB's most recent report at the time. And the Representative Beatty mentioned that this was the first time in history that there was no discrimination in 6 months. Do you really expect to believe that? Craig Nazzaro responds with, it's not a measure of discrimination happening. Back and forth was, so there was no discrimination, we just didn't deal with it, Beatty said. You know, this criticism is then reflected in, you know, the hyper-focus a year later by the CFPB under Director Craig Nazzaro with some fair lending activity coming out. In the last 2 months, you saw multiple enforcement actions over redlining and ACOA violations, mostly in the mortgage, non-bank mortgage lending spaces, which was a concern of a Cordray era CFPB. So it's interesting to see how it's not exactly split along party lines here. While there was no enforcement activity in 2019, it really has increased, and it really was focused on the spaces that the Obama era CFPB were focused on in that non-bank mortgage lending space. Next slide, Brad. We alluded to this earlier as well, the women and minority-owned small business reporting requirements. Section 1071 of the Dodd-Frank Act amended ACOA to require, subject to CFPB rulemaking, financial institutions to collect, report, and make public certain information concerning credit applications made by women-owned and minority-owned small businesses. This is basically going to be a HMDA-style reporting for small business commercial lending. It's been in the works since the CFPB and Dodd-Frank were rolled out in 2011. But it's interesting because now we're looking at it through the lens of PPP. We just had this large-scale small business lending, and we saw some of these questions asked on the forgiveness application, how it's tracked. We're starting to see it now in the, we're being warned about it in the supervision activity that our clients are going through now. That we're literally being told, you know, how are you testing these? How have you rolled these into your disparate impact testing, your regression testing to your entire consumer and resi mortgage portfolios? It's not a guess now. When we first saw these PPP loans roll out, we saw the CFPB guidance, we saw the CFPB blog post about, hey, you know, ACOA does apply to these loans, make sure you have this implemented. And we've been warning since those pieces of guidance were issued back in April of this year that this was going to be an issue. We're now actually starting to see that pick up steam in actual implementation. EICs are asking these questions in actual exams. As we roll into 2021, it's going to be a large portion of your exam when they start looking back at the PPP activity that you had. And then when Section 1071 starts to enter a final rules phase, you'll start to see it in your everyday supervision activity. You should start to see it built into your fair lending programs. Next slide, Brad. We also want to touch on the CFPB rule promulgation activity. Here's just a small chart of their spring 2020 agenda. If you're not looking at the CFPB's agenda, biannually they post what is on their rulemaking agenda, what they're working on. It changes from time to time. There's been some on there that have been on there forever. Debt collection rules have been being worked on for over 5 years now. When the Cordray CFPB was working on it, we were very concerned of what the proposed rule looked like, the notice of proposed rulemaking looked like. It looked like it was going to cover first-party and third-party debt collection. We're going to get a little bit more into this in one of the subsequent slides, but that is one that we should be focused on. We were supposed to see that final rule come out this month, but we haven't yet. If it doesn't come out before the election, it's going to be interesting to see if they push it through, if the administrations change. If Biden's elected, will a Craig-Nazzaro CFPB push that final rule out, or will we wait until post-January and the CFPB rethinks what's in that proposed final rule? Some of the other more interesting ones on there that we're going to take a closer look at is the clean energy financing, which is in the pre-rule stage, the business lending data, which we just talked about for a second, the Section 1071, and the transition to LIBOR, all stuff that's going to be highly impactful in 2021. Next slide, Brad.
Here's a pretty interesting one, and I think it kind of shows where potentially that there's not a lot of partisan back and forth. Instead, here we're talking about the PACE program, which is a clean energy finance program. For a long time, these have not been regulated under Reg Z as loans. Instead, this is on-bill financing of clean energy improvements. Long time push to have this come under ability to repay, as well as Reg Z for truth in lending disclosures, because there is recourse against the borrower or the person's home if he or she does not make payments under that financing arrangement. Again, expect something to come out in 2021. There's not a lot of debate, side to side, but we really just kind of use this as we go through the rulemaking agenda to say, in a lot of cases, if you're in these areas, be prepared for these regs, because we don't think there's significant debate as to whether or not they will be coming out. There may be some level of debate as to what is included in the rules, but it's going to become regulated. So, Craig, I'll turn back to you.
Thanks. So just in the interest of time, I'll start to go through these a little faster. The FDCP updates, the 2020 rulemaking agenda that we were discussing 2 slides back, we have some bullet points here about what's left in it when the Bureau released the comments on the proposed debt collection rules and the proposed rule in 2019. You see some of the high-level metrics there, like the imposed strict limits on how frequently debt collectors may call consumers. It was currently sitting at 7 times per week, 7-day break after contact. That, believe it or not, is more permissive than initially thought when it was being developed under a Cordray administration. Provide a model debt collection notice that would be sent to a consumer with a tear-off for the consumer to respond. This is particularly concerning because it'll give almost an automatic way for the borrower to contest the debt. What was taken out here was some of the LEP issues. What languages do you have to send that debt collection notice in? Some of that was addressed under the Cordray-run CFPB and was talked about within the advanced notice of rulemaking, but has since been scaled out. These are some of the issues that we might see put back in, or we might see in subsequent rulemaking agenda around the FDCPA if this rule actually is issued prior to a change in administration if one occurs. Also, time-barred debt is addressed within this rule. That might also look very different. And first-party versus third-party. It was initially stated by the CFPB that first-party debt collection was going to be addressed in the FDCPA under Cordray. Cordray then stated right before he left that we're not going to include first-party debt collection. The FDCPA updates will only address third-party, but there will be a secondary first-party rule coming. Once Mulvaney took over, we never heard anything else about that first-party rule that was going to be promulgated. If there's a change in administration, I fully believe that we'll start to see that first-party rule start to take shape in the coming year. And that would drastically change a lot of our approaches to debt collection. Right now, most of us that are in the first-party spaces apply the FDCPA as a best practice, but we know we always have that first line of defense there that we're not subject to it. It's our debt. That would disappear if that first-party rule actually came to fruition. And most of us would have to take a good, thorough look at our policies and procedures around debt collection in the first-party spaces. Next slide, Brad. This is a good one. Artificial intelligence and machine learning is also on the agenda. And Brad, correct me if you think differently, but I start to see this as one of the issues that is not along partisan lines. You've seen some activity within a Craig-Nazzaro and Mulvaney-led CFPB, And I believe you're going to you continue to see it in a CFPB run by a director that was appointed by a possible Biden administration.
I think you're exactly right. I mean, I think anybody who believes that, the results of the election would impact fair lending focus, would impact the regulation of fintech, machine learning, AI, or would impact privacy, and particularly some of the open banking initiatives, I just don't think anyone believes that will change. I mean, those are all hot button items that cross both party lines. And I think all of us need to be prepared in 2021 to really place a focus on that, particularly here with some of the AI. And so with many of our fintech companies that we work with, this is really driving a lot of this, which is how do you disclose when you have a 5,000 item underwriting model that's pulling data sources from across the world into your underwriting matrix? How are you going to disclose that? And the Bureau is really, I think, trying to get ahead of this and try to take a proactive approach on defining it, one, so it's clear for the fintechs, but also creates public or accountability to consumers and the public for those choices that are being made. And this has become such a big model. I don't think there's any way there's no regulation in this space. And I think the industry wants it as well, which is we're all doing it by analogy at the moment with so many of these things. It's like in PACE financing, we're trying to analogize it to what it is that exists under existing structures. This additional clarity, I think, will be welcomed by both sides of the political spectrum.
Yeah, to Brad's point there, like a lot of the fintech regulation that we're seeing, or a lot of the guidance that we're looking for, in my opinion, or in our opinion, I think we share the same opinion, is that some of the disruption is necessary. It goes outside of consumer protection in the U.S. and the relevance of the financial services industry on a global scale. You'll start to see the UK and other countries get ahead in areas like payments, real-time payments, or fintech lending or non-bank lending. And if the U.S. doesn't keep up with the technology-driven disruption, it's going to create problems for the industry itself, not just from a partisan perspective, but literally a global leader perspective.
Yeah, and I think, too, with this is going to come the ongoing fight between state and Fed. It's been magnified here in the last few months with the OCC yesterday finalizing that rule on valid when made. But, there is going to be ongoing pushback, I believe, between states and Fed, particularly the prudential banking agencies, as to the role of banks and the role of fintech and non-banks in the financial services industry in the U.S. The states are going to be constantly clawing back for that right to internal regulation of money transmission and lending. The banks certainly in the last few years with the blessings of the prudential regulators have been aggressive in asserting their role as the facilitator of nationwide fintech programs. And I just think that's going to continue to be a fight, and it's somewhat interesting in that both sides can approach that. If you're from the more progressive side of the spectrum, some have advocated for a broader role of banks in the fintech economy because it is regulated. It is significantly overseen by prudential regulators who have experience. Others view these types of partnerships as a way of avoiding state-based regulations and would prefer that these fintechs simply go to each state and obtain lending and money transmission licenses. Conversely, if you're from kind of the Republican side of the world, an enhanced role for banks, innovation in the fintech sector, and ways to avoid fractured regulation at the state level can all be things you're advocating for as well. So I think between those two, there'll continue to be pushes at the federal level for an increased role of banking institutions in fintech and in non-bank models, while the states continue to try to pull some of that power back or pull some of that oversight ability back.
That's a good to move to the next slide. It's a good introduction to this one. And this is where I find it to start to get fascinating. Like when you look at, under a Trump administration, we have an acting comptroller of the OCC through Brian Brooks, who's been, in my opinion, the most active on social media and just with the statements any OCC comptroller I've ever seen. And part of that is his background coming from the cryptocurrency spaces and an understanding of payments and the need for the country as a whole to start to move towards this disruption and start to embrace the fintech solutions that are gaining steam every day. He's been pushing the fintech charters and this new payments charter that we have outlined here on the top, that June 25th, 2020 quote, where he said the OCC is planning to unveil what he called Payments Charter 1.0 as soon as this fall. We haven't seen it yet. Will we see it if there's a change in administration? We don't know. Will Brian Brooks be there if there's a change in administration? We don't know. But it's a very interesting dynamic there because he's looking to disrupt the financial services industry. He's constantly pushing for, the bank model partnerships, getting non-traditional lending sources access to the Fed. As you see, Model 2.0 of that payments charter, he's saying the agency would roll out version 2.0, which he anticipated would include direct Fed access. Most recently, last week, he had a podcast. There was a conference, the FinTech conference, where he said human beings need financial services. They don't need banks. This is where it gets to be an interesting relationship. Coming under a Trump administration, you would think that there would be a very bank-friendly comptroller of the OCC, and he's making statements that people need financial services. They don't need banks. He went on to clarify that statement, saying that banks don't have. I'm not saying that banks don't have a future or a valid need within the industry. They absolutely do, but he just sees it very differently with the movement of money, the money transmission, or fintech's role in the financial services industry is very different than we've traditionally seen it in the U.S., especially under a right-leaning administration where you generally see less regulation. He's looking to open that up and give access to more entities that normally wouldn't have access to traditional banking products or traditional banking platforms. So it'll be very interesting to see how that plays out. I don't think either party can afford to sidestep the issue. It's going to have to be addressed head-on. What that looks like under a Biden administration, I don't think I could tell you. I don't know if you have any thoughts on it, Brad, or what that looks like even under a Trump administration continuing. I don't know what that looks like. If Brooks stays in there, I can tell you the OCC seems very determined to get a new charter up and running. If that fintech charter from 2016 that's mired in litigation still in New York, or this payments charter that we haven't seen formally presented yet, but we've heard him talk about multiple times, no matter what it looks like, we will see a version of that charter come out if the Trump administration is elected again. Brad, anything else on that?
Yeah, I think that's a good point. I mean, I think, in terms of what happens with bank model partnerships or even the fintech charter push, I think a lot of this depends on what type of control, if there is a change in administration, the Biden administration would take over the agencies. Yeah, I think right now there is a fear amongst the Biden campaign and some of the supporters there that the combination of decreasing federal regulation or just traditionally the lack of substantive regulation at the federal level, meaning traditionally the feds don't regulate the interest rates you can charge, don't regulate, it's more of a disclosure-based issue, and they leave it to the states to regulate the substance of financial products. In light of that, I think it would be hard to really push aggressively bank model partnerships or fintech charters. But at the same time, as I say, I think there's a very valid argument to be made that forcing fintech and forcing non-bank entities into the regulated world of banking may accomplish many of the goals that the Biden camp could espouse. So, I'm really interested. I don't know if there's been a public position taken by the campaign on this, and so it's a really tough question as to what they would do with this kind of delicate balance we're currently seeing.
What it means operationally, I would say too, Brad, is you should be thinking about it just from your own planning perspective. If you're in a compliance role, how are you equipped in your compliance department to start to look at these issues? Bank partnership, a fintech partnership, or a move into a more digital space. If you're not in a compliance role, maybe you're in a more credit risk role, or just on some of the operating committees. You want to start to look at it like, what does this mean for our growth plan? What is this? Is it organic growth? Are we growing through acquisition? What do those acquisitions look like? Or is it more entities that are heavy in the digital spaces? Are we not in the digital spaces? Are we not looking at non-traditional lending sources? Are we missing an opportunity with these neobanks that are popping up, that are offering credit and deposit products to underserved populations? Those are all issues that we should start to be thinking about now, no matter what administration gets elected in November.
I think that's a great point, Craig. And I'll just leave it with thanks everybody for joining us today. I think regardless of the outcome next week or whenever we know the results of the election, be prepared for 2021. I think you're going to see a shift again as we saw in 2016. If you are a compliance professional working inside of financial services, really be preparing your board and management that regardless of the outcome of this election, I think you need to be prepared for either the Trump administration to really aggressively put in place some of the agenda items that we've been talking about, or conversely, a swing back to traditional, Obama era regulation. If the election outcome is the opposite. In any event, be prepared because with the hyper focus on post-COVID electronic financial services, post-COVID uses of financial services, and the kind of bipartisan support for a responsive financial services sector that's being used as a tool to respond to the pandemic and the needs of consumers, I think you're seeing a significant shift over the last 6 months as to how we regulate financial services. And so with that in mind, just want to thank everybody for joining us today. We'll talk to you again in 2 weeks. As with all of these, this presentation, as well as a recording of it, will be posted online, either on our YouTube channel or on our blog where you can access the slides. Feel free to use them, distribute them as you want. Feel free to email us next week and make fun of us if things come out opposite the way we predicted. And certainly if you have questions or thoughts, feel free to reach out to us by email or call. Always interested in talking to folks.
Sorry to interrupt, Brad. I did see one question, not to make this longer, but there was one question from the audience that do we see a Biden presidency impacting asset-based lenders who do not fall under the purview of the FDIC, specifically non-regulated companies who lend directly into businesses? Brad, tell me if you disagree, but I think we do. I think under a Biden presidency, we start to see a focus on non-bank lenders and the oversight of them. In 2016, we saw some reports where they were looking at mortgage servicing entities, non-bank mortgage lenders. I don't know if I remember seeing anything specifically around asset-based lenders, but they were worried about the systemic impact of that lack of oversight, whether the FDIC is lacking the oversight or the CFPB on the consumer side is lacking oversight. So I do see some committees being reopened up and then starting to look at that issue again. I know COVID actually spurred some issues with non-bank mortgage servicers. It started to become an issue when there wasn't liquidity there if the payments weren't being made by the GSEs, if these defaults and forbearances continue to rise. With the changes in risk rating and the migration of MSRs from depositories over to non-bank servicers, we saw the non-bank servicers market explode for that reason, but they don't have the same liquidity requirements, and that was a strong concern of the Trump administration, even like thinking, hey, if the GSEs aren't making these payments, they're not going to be able to continue business operations, and they hold 25 to 30% of the mortgages in the country. So I do think, go ahead, Bryce.
Well, I was going to say, and if we're talking about true commercial asset-based lending, in those circumstances, we've seen already a trend in New York and California with trying to bring additional, particularly small business commercial lending under the regulatory scrutiny that's existing in the consumer context, including things such as merchant cash advance and factoring, in addition to ABL. And so, yes, I think all that's on the table. I doubt they come out with it out of the gate, but with the push towards a focus on small to medium business enterprise commercial lending, particularly some of the fair lending concerns, and some of this is going to be driven of if you get a very progressive director of the CFPB or a very progressive Treasury Secretary. But if you look at that list, about probably a third to a half of those folks who are potentials on both of those lists would probably very much be interested in following some of the California and New York models and bringing asset-based lending and commercial lending more closely under the purview and supervision that we see for consumer lending. Craig, final thoughts?
I think that's everything. It's going to be interesting either way. I would leave us with, we always say that part of the cost here and the concern is not just the change in the way it's approached, but just the swing itself. The monetary cost and the FTE costs that are associated with that is a concern to everyone in the industry, and I think we just manage through it and be as proactive as possible.
And we'll leave you with this. Thanks so much for joining us. Talk to you in 2 weeks. If you haven't, go out and vote. Participate in November, and we will see you on the opposite side of the election. Thanks so much for joining us. Please stay safe, be well, and we'll talk to you in 2 weeks.